Good afternoon, everyone. This is Brad Matheny. This is the SPX500. I thought I'd spend a little time and share some details with you with regard to the longer term picture and using the techniques that I've taught you. I've drawn a lot of. Let me turn these off. I've drawn a lot of uh, trend channels and lines on these charts and playing around with a little Fibonacci structure, which I'm kind of investigating with these nines. I'll explain them to you later. There's another one down here off of a monthly chart. And what we're going to do here, folks, is first we're going to look at the channeling. So we can look at this post-COVID channeling, and we can come in here and we can try to take a look at the rejection area. Remember, the rejection areas are so critically important. We come across this rejection area. We're looking for others. We get one or two right here. We come across, and actually we have to come down in this area to try to really label the rejection area. We could say that we had a bit of a breakout right here, but ultimately we just kind of carry it right up here off of these lows. I'll set it up as a bright blue, and we will then clone it. Try to look for the highest levels where rejection is. We get them here, here, and here. You can see that we eventually rolled over right over here into a breakdown mode. Okay. And again, we had some early warning signs early. I mean, theoretically, if we went to this channel, that we had this breakout channel here, which would have changed this other channel quite a bit. So understand that it would have been more along the lines of that. And you can see this gave us a very clear indication that right here, we had broken out of the channel. We would have had to draw a new channel. So we would have had to come from this area across this area and then possibly moved it to here and here, giving us some very clear indication that we're getting rejection, rejection, rejection. Then we finally break down out of that channel as well. So what's happening here again, folks, is we're getting the same setup. Rally phase, nice, good buying opportunity off of long-term support. I'll show you how this is long-term support. Then we come up here, we get a rejection, decent buying opportunity, rejection, decent buying opportunity, rejection, decent buying opportunity, rejection again, and finally we close out of the trade. Now this channel is invalidated unless we get back above it again. We set up a secondary channel. This is still holding up okay. It gave us a bit of rejection, rallied back up, and then broke through it. Now at this point, we get this downward channel. You can see it gave us pretty good indications. One, way down here. This is the lower channel, and this is the extreme channel. So we got these extremes way down here, a secondary breakdown, maybe, and this is weekly. So remember, these are 5 days. Then we rally back up, get the rejection again, come all the way back down, rally back up. This is another short trigger, and it gives us a little opportunity. Then it rolls out of this cycle, out of this channel. Okay, so it's very solid in the overall with this. Now, our current channel here, coming off of these lows, this is the rejection area, rejection area, rejection area. We're moving higher, we're moving upward, we're in the channel, we're just off this rejection channel. In theory, we would think this would continue to move higher, but we're also at this previous resistance area here, which is a dual rejection point horizontally. And I want to point out that this adds a bit of a risk to the downside. Okay. So we've got to understand here that we've got a little bit of risk to the downside here. We've got a real breakdown potentially setting up in the markets. And we would be watching for some breakdown in this area, possibly setting it down to this 39.49 area. Now, what do these nines mean? These nines are a representation of short and intermediate term Fibonacci cycle sequences. Something that I can't describe to you yet because I'm still playing with it. Are these accurate? I don't know. I'm marking them because what happens is in environments like we see with price trend, what I'm trying to do is I'm trying to map what I call completed Fibonacci price theory sequences. So for example, we had a 9 here that ended a previous cycle, and we ran all the way through all of this price action and all of this price action to complete the cycle right here. Now, we are not anywhere close to a 9 yet. We're still in an upward trend. We're still in an upward. These are different. These are weekly triggers. These are monthly triggers. So when I come back to monthly, you see the bigger long-term chart. From this point here, the low in 2009, to this point here, where the 9 is, this took, and this is the 9 right here, this took all of almost what? Got to do the math here. 2018 to 2009. So it took all of 9 years to complete a Fibonacci price structure. This entire rotation all the way up was incomplete all the way up until it completed here. That means that the price move as far as this leg was done, as far as this leg was done. And now we're back over here as far as this leg being done. Now, what does this qualify us? This qualifies us that we are entering a new phase in the market. Theoretically, these new phases will prompt either an AB or an ABC or an ABCDE. In this case, this was essentially about 7 price waves all the way up to complete the total 9. And now I'm trying to evaluate this as far as these Fibonacci price spirals. And you can see here that we're very, very close to a price spiral here. I tried to pick the rejection area here and the middle rejection area here, which I could probably adjust a little bit to about right there. And you see how that puts us right in the heart of the matter right over here. We're kind of past the rejection point right now and looking pretty rejection-y right here. So again, because we're past this spiral, we've gotten a bit above it. I would think that price would be moving into a different type of a phase here. Now, secondarily, I really want to point out these longer term angles and lines. Okay, so we have a long-term line here, this blue dash line off of these lows across these rejection points. This becomes very strong support down here. We have a long-term high, this orange line across these rejection points, coming across these rejection points before the pre-COVID rally, and these match perfectly with this rejection point. This is also support way down here. Okay, now on the outside of that, what I've done is tried to take the peak in 2007 across the peak over here, and you can see how that's lined up perfectly through this rejection point here. Then I've created boundaries. And what I tried to do with these boundaries, I tried to look at the boundaries to try to cross this area, across this area, the rejection points, and try to give us a kind of an outer boundary for this range. So we have a moderate support level here. We have a moderate resistance level here. Just so happens that it's crossed our resistance level way back over here. So all of these levels are now starting to have an important role in where we're at. We now have support in this area, support in this area, very strong resistance in this area, very strong potential double topping formation, very strong threshold of resistance and rejection in this area and this area. You can see it here, rejection, rallied through it, came back down, up again, rejection, move back up, rejection. I'm very cautious about this ability for the market to potentially trend downward, and particularly how these Fibonacci price arcs and spirals are lining up. And I don't use them much, but I do believe that this is very important. And I do believe that the rejections that we're getting here are very important. So I'm going to move back down to a weekly chart. And what we're going to do here, folks, is we're going to look at this. Actually, let me try to go. I think I was on a daily when I did this. Yep, here we go. So this is the same price theory that we were talking about with price channels, looking for ranges, looking for extreme ranges. So I'm going to highlight this if I can get it. Now my mouse is touchy. Okay, let's try it again. Got it. Thank God. Okay, so now there's our upper range. Okay, so highlight that, make it a dashed line. So we have that upper range we got to once. We fall in here, we rolled out of it. We rolled into this area, moved into an extreme range out here, and rolled out of it. Now we're in this moderate upward channel, which I've tried to draw with these green lines. I've tried to draw a middle channel around these rejection areas. And what I believe we're looking at here, ladies and gentlemen, is an apexing formation. I believe it's going to be to the downside. A, B, C, D, E. Let me try to draw that. So we would have A, B, C, D, E moving into this area, moving the S&P down to SPX down to 4240, 4280, maybe a bit deeper. I'll show you the deeper levels as we move forward. We're essentially looking at potentially wiping out all of this rally phase and potentially really moving back into this downward phase, maybe into that 4,000 area. And I would preface that by telling you 4,100, 4,050, 4,000, maybe even 3,900, 3,960. In the long term, we've got the longer term picture here is that the major base here presents a very strong base and bottom. So this becomes our very big base, okay, for the completion of the Fibonacci 9. Now we've just got a completion of a 9 back over here, which is this side, completion of a 9 over here on this side, completion of a 9 over here on this side. This is the end of a fairly strong daily wave, okay? And what we're looking at here is now the beginning of a new wave. If this new wave stays true, we're going to go ahead and see this move downward, I would believe. And I would believe that we would be looking at some sort of support level back over around these areas, particularly around this 40-30, 40-60, 40-90 area. This area right here, this purple line, plays a very important role. But what I was trying to do, like I said, was really show you these channels and how they align. Okay, so we have the channels. We can see the upper and lower ranges. We can see we're in an upper channel. This gave us a lot of opportunity through here to potentially buy into this mode. We've come back up and topped. We've really struggled over here. We are still in an uptrend. We can't argue that this is not in an uptrend. I'm just very concerned with my custom indexes that we're going to move downward. Okay, so in fact, let me show you here. Live trades, no, Excel files, no, old desktop. Where am I? There we go. So these are some charts that my members get. And what I want to show you here is this is TradingView. I use TradingView a lot. It's very, very handy. Love the drawing tools. I mean, absolutely beautiful drawing tools. But this is one of the charts that shows custom market rotation to the downside. Okay. So what we have here is we have this rotation. You can see this. This is basically showing phases of the market. There's literally one channel, two channels, three channels, four channels across here, and then a fifth channel way up here. So if we break down below this fourth channel, we're going to move down here back into this third channel, which would represent a 10 or 15% or more downturn in the market. We're already seeing it weaken and we're seeing it lose support. This is all that speculative rally that took place after COVID. So watching it unwind back into this channel area or deeper down into this channel area would not be uncommon to see the markets unwind. The fear index is moving higher. This is the S&P 500. This is my custom sentiment index is moving lower. Sentiment index moving downward with fear moving higher and the cycle phase back over here moving downward. And we're got to see how this plays out, because in reality, we need to see this confirmed. But this is a very big downturn for September already. We have the valuations index, which again, I cannot tell you enough. This is one of my favorite charts. The valuations index has moved to a new session low in September. It's literally below the low of this bar and almost below the low of this white bar right here, which was our big rally. If we get below this level, if the markets get a little bit lower, we're going to be looking at an extended continuation of a devaluation cycle phase, possibly moving us down into this area, maybe even deeper down into this area. But this is an unwinding of assets, folks. If we had any type of economic growth, we would be looking at this type of activity. This is a general unwinding of asset classes and valuation. So again, we've got some real strong warning signs. The base trend index chart shows that global assets and US dollar-based assets are weakening at the same time. This is showing us essentially that traders are seeking out and searching for the next big opportunity, but we're seeing it slide downward. Downward trends typically represent downward trends in the SPY. You can see here, this is the base trend index moving downward. SPY moves downward. We are going to see what happens. We could get rejection off this purple line here, but we're very close to breaking down and moving into a new downward trend. So the next week or two is very, very important to know what's happening. And the smart money index has moved into trending indication. I believe we are in a downtrend. This is a weekly chart. We need to see how this plays out, whether this holds up. We get any type of upward activity, we're probably going to retest this level, because I think we're darn close to exiting this trend. Okay. And the volatility index, lastly, is very, very toppy with two dojis. To me, this is protect your capital. And again, this is longer term. These are weekly and monthly data. This is to kind of gauge what the general market is doing. To me, this is protect your capital, cut back your allocations, reserve your dry powder, your cash, and wait for the market to make a direction, a trend, and a move, which would be essentially the dailies kicking in. So you've kind of seen what's going on here. You can see we've got the end of the 9 cycle here. We would be waiting for the next major 9 cycle to set up, which we don't have. We're in the midst of trying to find a new 9 cycle ending phase here. But these end of cycle phases typically allow you to see where Fibonacci is actually peaking and troughing. So you think about these as, I'll spread them all out. You think about these as, here's major support off of these lows. Make this green or solid. So that becomes our major support. And that would be something we would operate off of in terms of trying to determine if we've got a rollover. Here is major resistance. So this would be a red line right here. We've already got one, but I'll draw another one. Major resistance still hasn't been touched. Very critical for us to understand. Secondary major resistance right down here, which again did get breached. That tells us that we had a bullish move. Then we have another major resistance right here, which we already have a line. I'll highlight that as a 4-pointer. And this tells us right here, ladies and gentlemen, that we essentially, if you look at this from a broader term picture, this was our long trigger right there. That was a long trigger because that got above our 9, our major 9 resistance. Now we're back up over here. We're already above this level again. So again, these levels, they play out and they carry out. So now we would be watching for this 4280 level, 4275 level on the SPX500 as a potential breakdown level. We've already gotten above this level. We've already gotten above this level. Now we need to see if we can get above this level. If we cannot get above the 4636 level on the SPX, then we are going to roll over and move downward. Okay, this is kind of what I do, and this is how I help you. So visit my website, check out my profile. Let me know what you think. Thanks, guys.